and welcome to the Property Wealth Podcast. If you're looking to dive into real estate investing, you're in the right place.
Absolutely, Sarah. Today, we're tackling some really exciting strategies like VRBO and Furnished Finder.
Right? These platforms are game changers for generating income, especially if you're looking to maximize your property investments.
They really are, and what's great is that whether you're just starting out or you've got some experience under your belt, there's something here for everyone.
Exactly. We'll discuss how to get started, the pros and cons of each platform, and some tips to make your properties stand out in a crowded market.
And, of course, we'll touch on how to navigate the local laws and regulations, which is so important.
Yes, and I think people will appreciate our insights on how to create a memorable guest experience that can lead to repeat bookings.
Definitely. There's a lot to cover, so let's jump right in and explore how you can tap into these lucrative opportunities.
Perfect. Let's kick things off with VRBO. What do you think is the biggest draw for investors looking at that platform, Mike?
You know, Sarah, one of the biggest reasons this topic really strikes a chord with folks over 40 is that many are starting to think more about their retirement timeline and how they're going to fund it.
Absolutely. It's like a light bulb moment for a lot of people. Suddenly, they realize that their current savings might not be enough to maintain their lifestyle in retirement.
Exactly. And with inflation being what it is, that's a real concern. I mean, just look at how prices have gone up in the last few years. It's not just about saving money anymore. It's about making sure that money works for you.
Right, and real estate, especially short-term rentals like VRBO or platforms like Furnished Finder, can really help hedge against that inflation. I mean, if you're renting out a property, you can adjust those rates to keep up with rising costs.
Yes! And it's not just about the money, either. There's this emotional side to it, too. I've talked to investors who say that knowing they have a cushion, like a rental property, gives them peace of mind. It's not just a financial strategy. It's about feeling secure about the future.
That's such a good point. I remember one investor I spoke with, let's call her Linda. She was in her late 50s and had been saving for retirement, but her nest egg felt a bit fragile. She decided to invest in a couple of short-term rentals, and she told me how empowering it felt to have that additional income stream. It was like she took control of her financial future.
Exactly. And it's those stories that resonate with people. Linda not only created a new revenue stream, but also increased her property value over time. So it's not just about immediate cash flow. It's also long-term wealth building.
And for many, it's about leaving a legacy for their family too. I mean, think about it. Having that property to pass down can really set up the next generation for success.
Totally. I've seen families turn a single rental property into a multi-generational asset. It's like planting a tree that continues to grow and provide for years to come.
Yeah, and it's not just about the financial aspect. There's a certain pride in owning property, knowing that you've built something meaningful that can benefit your loved ones.
Right, and considering current economic trends, it's an interesting time to be looking at real estate. With interest rates fluctuating and the real estate market shifting, it creates opportunities for savvy investors who are willing to adapt.
For sure. I mean, some people might be hesitant or fearful of market changes, but those who can pivot and recognize new opportunities will be the ones who thrive. Short-term rentals, for example, can often generate higher returns compared to long-term traditional rentals, especially in desirable locations.
Exactly. And think about how travel has changed. People are more inclined to seek out unique experiences, especially after the pandemic. They want homes, not just hotels. This is where VRBO comes into play, allowing you to cater to this market.
That's a great point. And for those who might not want to manage properties directly, platforms like Furnished Finder can connect them with traveling professionals looking for midterm stays. It's a whole new audience to tap into.
Yes! And it can be less chaotic than managing a full short-term rental. Midterm rentals are often more predictable too. You can establish a routine with your tenants, which can be less stressful.
Right, and with the right strategy, it can become a reliable source of income. Plus, it allows for flexibility if you still want to use the property for personal reasons.
Absolutely. You can block off time for yourself and still make money when you're not using it. It's like having your cake and eating it too, you know?
Haha, exactly. And for those over 40, this can be a game changer. It's not just about the income. It's about creating that financial freedom to enjoy life more. to travel or spend time with family without the constant worry about finances.
That's a wonderful realization, and it's achievable. I've seen so many people, like our friend Linda, find that balance and thrive. It's about making your money work for you, so you can focus on what truly matters.
And it's also about being proactive. Waiting too long to make a move can lead to missed opportunities. The real estate market is always evolving, and those who stay informed can capitalize on these shifts.
Exactly. And it's not to say that you have to jump in blindly. Doing your homework and understanding the market dynamics is crucial.
Right, and having a solid plan in place can make all the difference. It's about being strategic, not just reactive.
Yes! And this brings us to the core strategies that we can share today. Let's dive into some practical steps. So when we talk about VRBO and Furnished Finder strategies, one of the first things we need to keep in mind is the 1% rule.
Right, that's a good starting point. For those who might not be familiar, can you break that down for us?
Sure. The 1% rule suggests that the monthly rent you can charge should be at least 1% of the total purchase price of the property. So if you buy a property for $200,000, you should aim to rent it out for at least $2,000 a month.
That makes sense. So if you're looking at a property and the numbers don't add up to that 1% rule, it could be a red flag, right?
Exactly. It's a quick way to gauge if a property is worth considering. But remember, it's a guideline, not a hard and fast rule. Market conditions and property features can influence rental prices.
And that's where doing your homework comes in. What about the 50% rule? I've heard that one mentioned a lot too.
The 50% rule is super helpful for estimating operating expenses. Basically, it suggests that about 50% of your rental income will go toward expenses like property management, maintenance, and utilities.
So if you're expecting to make $2,000 a month in rent, you should budget around $1,000 for those expenses. That's a pretty handy formula.
Exactly. And it helps you get a clearer picture of your cash flow. If you follow that rule, you can also calculate your net operating income.
Right, net operating income, or NOI, is crucial for evaluating deals. How do you calculate that?
Well, it's pretty straightforward. You take your rental income and subtract your operating expenses. So if you're making $2,000 a month and your expenses are $1,000, your NOI would be $1,000.
And that gives you a baseline for understanding how profitable the property could be.
Yeah, and once you have your NOI, you can dive deeper into the cap rate, which is another important metric.
Cap rate? That sounds a bit technical, but really important. What is it?
The cap rate is the ratio of your NOI to the property's value. You can calculate it by dividing the NOI by the purchase price. So if your NOI is $12,000 a year and the property is worth $200,000, your cap rate would be 6%.
Got it. So higher cap rates generally indicate better returns, right?
Exactly. A higher cap rate means you're getting more income relative to what you've invested. Generally, a cap rate of 8% or more is considered good for rental properties.
That sounds like a solid benchmark. But how do these numbers play into the specific markets for VRBO or Furnished Finder properties?
Well, market research is key. Look for areas with strong demand for short-term rentals, like tourist destinations or cities with large events. You can also analyze occupancy rates.
Occupancy rates? How do you find those?
You can get that information from platforms like AirDNA or even local real estate websites. They show you how many days a property is booked compared to how many days it's available. High occupancy rates are a good sign.
So if a property has a high occupancy rate, it suggests that there's a strong demand for short-term rentals in that area?
Exactly. And once you've identified a good market, you can start evaluating specific properties. It's helpful to have a checklist for what to look for.
A checklist sounds like a great idea. What would you include on that?
Well, first, consider the location. Is it close to attractions or amenities? Next, think about the property type. Single-family homes, condos, or multifamily units can all work, but each has its pros and cons.
And what about the condition of the property? That must factor in too.
Absolutely. You'll want to assess any needed repairs or renovations. If there's a lot of work to do, that can eat into your profit margins. Also, look for unique features that can make the property more appealing to guests.
Like a hot tub or a nice outdoor space?
Exactly. Those amenities can really boost your rental income. And don't forget to consider zoning laws and regulations around short-term rentals in that area.
Right, because some places have restrictions that could limit your ability to rent out the property short term.
Exactly. And financing options are another crucial aspect. If you're new to this, traditional mortgages might be your go-to, but you can also explore options like portfolio loans or even hard money lending.
What's a portfolio loan? I've heard that term before.
A portfolio loan is held by the lender rather than being sold on the secondary market, which can make it easier to qualify if you have multiple properties. It's a flexible option.
That sounds useful, especially if someone is building a portfolio.
For sure, and think about your down payment. If you're buying a short-term rental, some lenders might require a larger down payment compared to a primary residence.
So it's important to be prepared for that too.
Definitely. And remember, all these strategies and numbers are meant to help you make informed decisions. But with any investment, there are also pitfalls to watch out for.
Like what?
Well, one common pitfall is underestimating expenses. Many new investors only focus on the mortgage and forget about things like property management fees, utilities, and, maintenance costs.
That could really eat into profits if you're not careful.
Exactly. And then there's the risk of relying too heavily on seasonal income. If you're in a tourist-heavy area, you might have great income in peak seasons, but struggle in the off-season.
So having a solid strategy for those slower months is key.
Yes, and diversifying your rental strategy could help. You might also want to consider longer-term rentals during the off-peak season.
That's a smart approach.
And don't forget about the importance of marketing your property effectively. It's not just about listing it. You need good photos, a compelling description, and maybe even a social media presence to attract guests.
Definitely. And staying on top of guest reviews can make or break your rental reputation.
Right. Responding to reviews, both positive and negative, can help build trust and encourage more bookings.
So much to think about. But with the right strategies and a little diligence, it can definitely pay off.
Absolutely. Just remember to stay informed, keep assessing your numbers, and adapt your strategies as needed.
Great advice, Mike. This really opens up a lot of avenues for our listeners.
Glad to hear that. Yeah, Sarah, one of the biggest pitfalls I see with investors jumping into the VRBO or Furnished Finder space is over-leveraging. It's tempting, right? You buy a property, think you've got this great rental income lined up, and then you stretch your finances too thin.
Absolutely, Mike. I mean, it sounds great on paper. You see those numbers and think, wow, I can make a killing. But then, what happens when the market shifts or you have unexpected expenses?
Exactly. I once had a client who bought a beautiful property in a popular area, but they put almost everything they had into it, thinking they'd just keep cash flowing. Then, out of nowhere, they had a major plumbing issue, and they didn't have reserves to cover it. It really hit them hard.
Oh, wow, that's a tough situation. So what could they have done differently?
Well, one key thing is to always have a solid reserve fund for emergencies. I recommend keeping at least 3 to 6 months worth of expenses set aside. That way, if something does go wrong, you're not scrambling to cover costs or falling behind on payments.
Right, and speaking of unexpected expenses, what about bad tenants? That can really derail your plans, can it?
Oh, for sure. Bad tenants can be a nightmare. I had another client who didn't thoroughly vet their tenants. They thought they could just trust the first person who applied. Well, it turned out to be a disaster. They had constant complaints from neighbors about noise, and then there were late rent payments.
Yikes! That's really stressful. What should people look for when they're screening tenants?
A good screening process is crucial. You want to check references, run credit checks, and, maybe even meet them in person. Look for red flags like inconsistent job history or a lack of previous rental experience. If they're hesitant to provide information, that's usually a warning sign.
Makes sense. And then there's the cash flow thing. I think a lot of people underestimate how important it is to keep an eye on that.
Yeah, it's really the lifeblood of any investment. I've seen investors who get so caught up in the idea of short-term rental income that they ignore long-term cash flow. They might have high rental rates, but their expenses can quickly eat away at profits.
Right. So they think they're making money, but in reality, they're just treading water.
Exactly. I had a friend who invested in a high-end property. The nightly rates were fantastic, but they didn't consider the costs of utilities, maintenance, or cleaning services. When all was said and done, they were barely breaking even. It's important to do a detailed analysis of all potential costs before making a purchase.
That's such a good point, Mike. I think a lot of people get excited about the potential income and forget to do that homework. And what about timing the market? That's another common mistake, isn't it?
Yes, it is. Timing the market can be tricky. I know people who wait for the perfect moment to buy, but the truth is, you can miss out on great opportunities if you're too cautious.
Right, you don't want to be stuck waiting indefinitely.
Exactly. I had a client who waited for what they thought would be a better price. But by the time they pulled the trigger, the market had already shifted and prices had gone up. They lost out on a fantastic property just because they were waiting for that ideal moment.
So it sounds like the lesson there is to focus more on your own investment strategy rather than trying to predict the market.
Definitely. And, hidden costs can also catch investors off guard. Things like property management fees, maintenance, or even HOA fees can add up quickly.
Oh, for sure. I think a lot of new investors overlook those. They just see the purchase price and think that's it.
Right? I had a colleague who bought a property in a community with a very high HOA fee. They didn't factor that into their calculations, and it significantly reduced their profit margins.
So how can someone avoid those hidden costs?
Well, it's important to do thorough due diligence. Read contracts carefully, ask about all potential fees, and factor those costs into your financial projections. And don't hesitate to ask the current owner or property manager about their expenses. Get the full picture.
That's solid advice, Mike. So if someone realizes they've made one or more of these mistakes, what can they do to recover or avoid them in the future?
Well, first, it's important to acknowledge the mistake and learn from it. You can always adjust your strategy. If you're over-leveraged, consider refinancing or finding ways to reduce expenses. For bad tenants, maybe look into better screening processes, or even hire a property management company that specializes in that.
Great points. And keeping a close eye on cash flow is key, right?
Absolutely. Regularly review your finances and adjust your rental prices if necessary. Being proactive can save you from bigger problems down the road.
And as for timing the market, just focus on your own goals rather than trying to time it perfectly.
Exactly. Investing is a long-term game. Even if you make a mistake, don't let it derail your entire plan. There's always a way forward if you stay committed and informed.
Such valuable insights, Mike. Thanks for sharing all this. I think our listeners will really appreciate these lessons as they navigate their own real estate journeys.
All right, Sarah. Now that we've dived into the VRBO and Furnished Finder strategies, let's talk about what our listeners can do right now to take those first steps.
Absolutely. It can feel overwhelming, but breaking it down into manageable actions is key. So where should someone start?
Well, first off, I'd suggest they assess their current situation. Take stock of what they have, whether it's some savings, a property, or even just a keen interest in real estate. Just starting with that awareness is really powerful.
For sure. And once they have a clear picture, what's next?
A good next step is to analyze potential deals. You might want to set a goal to look at one new property each week. Use platforms like Zillow or Realtor.com to browse listings in your area. Just get familiar with what's out there.
Yeah, I love that. It helps to build your knowledge and confidence, and there are some fantastic tools out there for deeper analysis, right?
Exactly. I'd recommend checking out the BiggerPockets calculator. It's user-friendly and can help you run the numbers on any potential investment. You can see if a property makes financial sense before you even consider making an offer.
That's a great tip. And for those who are specifically looking at short-term rentals, DealCheck is another tool that simplifies analyzing cash flow. It can really make the process easier.
Right, and don't forget about Rentometer. It helps you gauge rental rates in your target area so you can set competitive prices or understand what to expect from a property.
Oh, and if someone's still in the early stages, local MLS access can be a game changer. Knowing how to navigate it can open up a lot of opportunities.
Definitely. And, while tools are helpful, it's also about building those habits. Joining a local real estate meetup or networking group can be invaluable. It connects you with others who are on the same journey.
Yes, surrounding yourself with like-minded people can provide motivation and insights you might not get otherwise. And it's a great way to share experiences and learn from one another.
Speaking of learning, I'd recommend picking up a couple of solid books on real estate investing. The book on rental property investing by Brandon Turner is a must-read, and Real Estate Investing for Dummies is a classic that breaks things down really well.
Those are solid choices. And for those who prefer audio content, there are some great podcasts out there too. BiggerPockets has its own podcast that dives deep into various strategies and real-world scenarios.
Right, and you can listen while you're doing chores or on your commute. It's a nice way to keep learning without it feeling like extra work.
Exactly. So, along with all these resources, how about setting aside a specific time each week, maybe Sunday afternoons, to review what you've learned or the deals you've analyzed?
Yes! Consistency is key. Even if it's just a half hour, dedicate that time to your real estate education. It turns into a habit, and before you know it, you'll be growing your knowledge base.
And don't forget to celebrate those small wins along the way, whether that's analyzing a deal or connecting with someone at a meetup. Every step counts.
Absolutely. And as you progress, you could also start looking into financing options. It might be a good idea to meet with a mortgage broker to understand what you qualify for and what options are available to you.
That's a great point. And having those discussions early on can help you feel prepared when you find the right property.
Yes, and as you get more comfortable, maybe consider creating a list of potential properties that fit into your investment strategy. Keep it simple. It doesn't have to be perfect right away.
Right. Just start where you are. And that list can evolve as you learn more about what you want and need in an investment property.
Exactly. And lastly, I'd say don't hesitate to reach out for mentorship. If there's someone in your area or network who's experienced in real estate, they might be willing to share their insights or even partner with you on your first deal.
That's such a valuable point. Having someone guide you through the process can make a huge difference, especially when you're just starting out.
So those are some practical first steps. Now let's bring this all together. Well, Sarah, what a discussion we've had today about VRBO and Furnished Finder strategies.
Absolutely, Mike. It's been really enlightening. So if we had to summarize, what do you think are the key takeaways?
Let's see. First, I'd say understanding your target market is crucial. Knowing who your guests are can really help you tailor your property's appeal.
Right, and that goes hand in hand with the importance of creating a fantastic experience for your guests. A little extra effort and hospitality can lead to great reviews and repeat bookings.
Exactly. And speaking of bookings, the financial aspect is huge. We discussed how pricing your rental correctly can make or break your profitability.
Yeah, and don't forget about leveraging platforms like Furnished Finder for long-term stays. It opens up a whole new audience and can provide steady cash flow, which is so important.
Definitely. And lastly, we touched on the value of networking. Connecting with other investors and local businesses can really enhance your success.
Those are such great points, Mike. And, it's all about building that wealth through real estate, step by step.
Right, it's a journey. It might seem daunting at first, but with the right strategies, anyone can start to create a solid foundation for their future.
So, listeners, we encourage you to take action. If you found value in today's episode, please like, subscribe, and share your biggest takeaway or any questions in the comments.
And if you know someone over 40 who's thinking about investing in property, share this episode with them. It could be just what they need to get started.
Absolutely. And next time, we'll dive into the exciting world of house hacking with multifamily units.
That's going to be a game changer for many.
So, until then, keep dreaming big and investing wisely.
We'll see you next time.
Bye for now.